currencies, governments, like great armies, they don't give up easily, even when the math clearly shows that they've had their Gettysburg moment, they've had their Waterloo, they've had their Stalingrad. They're going to lose. America and the dollar is going to lose one way or the other. It's just whether it's fast or slow. And I think it's going to be faster than people realize. It doesn't mean gold will only go straight up. It doesn't mean the dollar will only go straight down. There's a lot of nuances there, but it's very simple. We're way too in debt. We don't have the productivity to pay for it, and we're not taking accountability for it. And the austerity that's necessary to reshore manufacturing, to reshore jobs, is brutal. And the only way our country would support that type of austerity is if they trusted their leadership. I don't think there's a lot of trust right now in leadership in a very divided states of America, a very tribalized United States of America. There isn't a politician, who can tell the truth. And the truth is, Americans, like many citizens of the world, like to hear sweet little lies, like romantic partners. They want to believe what they tell you. They don't want to hear about austerity, debt, inflation, recession. Melee in Argentina could say it because by that point they were already on their knees. That country was overtly broke. It is impossible to imagine America like Argentina, and it won't be because it's home of the world reserve currency. But you need that kind of blunt leadership, and you need a population that believes in it, that asks not what their country can do for them, but what they can do for their country. It's hard to do that whether it's Biden or Trump in the White House right now. We're too divided. We're not going to galvanize and follow a leader necessary. And I don't know if we have a leader brave enough to tell the world and their country and their citizens how much we screwed up over the last 60 years.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When asked last month if the U.S. economy was heading into stagflation, Fed Chair Jerome Powell said he didn't see the stag nor the flation in the data that he looks at. Well, U.S. Q2 GDP growth estimates, as forecasted by the Atlanta Fed's GDP Now service, are plunging. And Q1's weak reported GDP growth rate of 1.6% was just revised further downwards to a paltry 1.3%. So that's some stag right there. And CPI remains solidly higher than it was 9 months ago. So that's some flation. To learn how to protect the purchasing power of your wealth in an increasingly stagflationary environment, we're fortunate to be joined today by Matt Piepenburg of Greyerz Gold. Matt, thanks so much for joining us today, all the way from your home office in Europe.
Yeah, well, it's great to be back, Adam, as always.
Hey, Matt, it's always a true pleasure talking with you. Let's just roll up our sleeves and dive right in. I got a lot of questions, but we'll just kind of plow through them as best we can as the conversation takes us. But to kick it off, what's your current assessment of the global economy and financial markets?
Look, it still starts with the four-letter word. The dirty word is debt. As we've talked about, debt changes things. And if you listen to von Mises or David Hume or Reinhardt and Rogoff, debt also destroys things. And it sounds dramatic, but the impact that unsustainable or irrational debt levels have on markets and on currencies and on politics and social structures and war cycles and demagoguery and even centralization and opportunism politically is undeniable. And I think this debt is how I look at the world globally. It starts with debt because the world is approaching 400 trillion in global debt. Obviously, the U.S. is about to hit 35 trillion in public debt. It's got 210 trillion in unfunded liabilities, et cetera. Its debt to GDP is over 120%. Its deficit GDP is around 6 to 7%. And that's not even with an official recession on the headlights. So, as facts change, opinions change. What I'm finding is the facts are just getting worse and my opinions are getting more entrenched. And that actually concerns me at the global level, because I really do endeavor, and I will try to today, to look at both sides, because when you're talking about precious metals, you're obviously talking your quote unquote book. If you're an executive in Switzerland with a large amount of money in gold, you're going to have an opinion and a bias. But again, I want to be able to look at gold and bond markets and currencies and inflation, deflation, et cetera, from both sides to give your audience a chance to look at both sides. I obviously have my views. For me, when I look at any vertical at the macro level right now, if I pull any thread, whether it's on debt facts that I kind of just throw out there, or rate markets or bond markets, and that includes private credit and junk and triple C, triple B spreads in the junk market, which no one wants to look at, SPACs. When I look at economic and recession indicators, when I look at inflation forces, the US dollar, the COMEX, the price discovery in gold, and most importantly, Adam, when I look at history, all those threads point to a tapestry that ends in gold. And in a sense, as I said, gold is so obvious now to me at an historical and mathematical level that it concerns me because I feel too good about it. And the only sad reason you can feel that good about gold is I feel that cynical about currencies, about politics, about debt, credit, and rate markets. And so all these things tie together. But my macro view is we're not nearing the cliff. We're at the cliff at a debt level, not just in the U.S. but everywhere. But we're the home of the world reserve currency. We're the home of the risk-free return, so to speak, of the 10-year Treasury, that super important sovereign bond. So when America is this distorted, and when debt is this distorted, and when the debt trap the central banks are in is this obvious, I don't see any other way but a discussion on precious metals. You could include Bitcoin and other anti-fiat, but the paper money is reaching its endgame, and that again sounds sensational, but the evidence is literally everywhere. So that's my assessment of the global macro environment. It's pretty negative. It doesn't mean the end of the world or even the world reserve currency, just a very different world.
Okay. So that's your macro perspective. When it comes to markets, and we're going to talk more about gold and the macro side here, but when it comes to the markets, does that mean you feel that they're overvalued today given a coming reckoning, or could it be the kind of thing where, hey, it's just the purchasing power that gets destroyed, so nominally these things might do fine nominally,
Yeah.
as prices just become
Yeah.
funny money?
Yeah, it's interesting. I mean, well, when I look at the bond market, when you look at risk assets, you have to separate equities and bonds first and foremost. I've seen very smart people call for the worst market sell-off ever coming in the next 12 to 16 months. I've had others, including very smart folks that I really admire, like Luke Groman, who think that, as long as there's liquidity, even if it's fake liquidity in various different forms, that the equity markets, even as narrow as they are and as grotesquely overvalued as they are, can nominally go higher. I kind of I'm kind of torn on that. I look at an S&P and certainly a Nasdaq this narrow, led by such a small handful of companies that aren't necessarily bad companies, but overvalued companies. And right now they have price and volume control, and their net income margins are real. But I've seen that movie before in the dot-com bubble with names like Lucent and
Mhm.
Qualcomm and Commerce One and other stocks that I was directly involved in. One was an IPO that made me a decent amount of money, but I know that those are not sustainable highs. What scares me about this current market, it's the only good story America has, is a rising market based on a lot of forms of liquidity. We haven't needed to pivot to direct QE yet, but this market receives liquidity in all kinds of nefarious forms. I call it backdoor liquidity. I think we should talk about that, but there is still liquidity, and there was almost a need for tax receipts out of this S&P for the federal government. They almost need to nationalize the S&P and the Nasdaq and the Dow as like a national 401k, because they need tax receipts and GDP to put a small dent in this debt bubble, which won't be enough. But there's almost a national security interest in propping up these markets. But I don't think that will be enough to fight off the forces of mean reversion, even in the equity markets, as supported as they are by all different forms of liquidity. The bond market is an entirely different story. And again, I consider the bond market as the real varsity players on Wall Street, the good ones. At PIMCO, there was Bill Gross. Now you've got Double Lines, Gundlach, Jeffrey Gundlach. He's many things, but he certainly understands the bond markets. And if you listen to Gundlach, I mean, Groman calls the bond market blood sport. But Jeffrey Gundlach, who knows bonds, sovereign corporates, and all the forms in between, says we're in the last mile of a credit implosion. It's just, he thinks, when we talk about actual inflation versus reported inflation, you'd have to be an idiot, he said, to buy these bonds, these sovereign bonds in particular, because you're literally, when you look at actual inflation, the moment you make your bid, you're losing in real terms, despite nominal coupons. And in the bond market, there's such an overt and obvious mismatch in supply and demand, in particular with the sovereign bonds. Again, since 2014, the world central banks of the world are net sellers of our U.S. treasuries and net buyers of gold. But the key buyers of our U.S. debt, foreign, outside of foreign individual investors, was China and Japan. And both of them, Japan is selling to support its yen, and China just dumped 53 billion more U.S. treasuries in the market in Q1. So the key buyers, and then globally, the central banks are openly selling our unwanted IOUs because we're a bad credit and we don't give a real return. So you can't deny what's happening in the sovereign bond space. In the junk space, I mean, there's so much. I mean, again, when we met back in Vancouver, and that was in January, but by November, Powell was promising some type of dovish 2024, and the markets were giddy on rate cuts, and even triple C junk bonds went up in price when their fundamentals were getting worse. That's what words, even replacing actual policies, can do temporarily in the short term to all risk asset classes and even junk bonds. But as Gunleck says and others, private credit is a disaster. Folks are leaving the bond market. A lot of these spreads are widening. I think, what do you do? What do you know? People know that bonds are overvalued and not giving a good return in actual inflationary terms. And they know that stocks are narrow and overpriced and is a risk of a blow off top. So they understand that. So what are they doing? And I've talked to family offices now in 3 continents this year. What are they doing? They're going to things they don't understand to try and get yield. And those are like the SPACs, these private credit pools that are not marked to market. They're a total scam, in my opinion, and in Gunleck's opinion, and in many other opinions. They're lockups with capital calls, and the investors have no idea what really goes on behind the scenes in those private credit pools. And an interesting example of that, and I'll end on this: even Harvard University, with a 60 billion endowment, recently couldn't pay its bills. They're so illiquid. I think Stanford's not much different, Adam. And that's a key indicator. I mean, the Harvard indicator, the uber wealthy and even these major endowments are so tied up in private credit pools and other liquid investments that are not marked to market that they think they're wealthy when what hides behind the scenes is a lot of default risk, a lot of credit risk. And I see this even among the uber wealthy at family offices. Again, I've been in Singapore and Turkey. I'll be in Wiesbaden and London and New York. It's astounding to me the sophistication of these banker kind of CIO-led family offices, the sophistication of their team, but they're kind of blind, out of sight, out of mind ignorance to the risk in a lot of the illiquid investments they're in. And the sexy things on their minds right now are VC or private equity or some of these SPACs or credit pools or direct investments or secondaries, and of course, some allocation to alternative investments and direct investments in the markets. But they're not wanting to see the shark fins just below the surface, and it's astounding. And I'm not saying that to mock them. It's a very smart groupthink, but the illiquidity of this so-called paper wealth is pretty scary. I think most investors are looking at the markets and they see a narrow S&P with a potential risk of a blow off top or even further heights if we get a rate cut or if we get some form of quasi QE that'll buy a little bit of time. But they do see risks in the credit markets. If they're taking further risk in the credit markets, they just don't understand it. And again, that may be sounding condescending. I was a family office executive. I know how they think. It's very smart people. They're very well diversified. They're very much listening to each other and following each other's leads and looking for these private credits or other direct investments, but they don't see the credit risk in them and they don't want to see it. And they have a hard time even understanding currency risk, which is something that gold or Bitcoin or other alt or anti-fiat options discuss, real estate or art or other forces. They're just starting to see that now, though. So long way of saying equity and credit markets, I think the jig is up. People see there's risk, even if there is upside risk, if the Fed pivots or if there's rate cuts or if there's more QE, that will be a tailwind in an already completely overvalued S&P Dow and NASDAQ. They're very clever and very aware of the nominal versus real return in the equity in the credit markets or the bond markets, and they're just taking more and more distant trips on that risk branch, reaching for yield in a very dangerous way. But I think they're missing the elephant in the room is even if they're lucky enough to squeak through the potential risks in those credit and bond markets, whatever returns they're going to be making are going to be in an inflated, debased, and devalued currency, whether that's the US dollar, the euro, or any other currency. And that I find fascinating. And as I talk to some of these family offices and they sit down and look at the math and the data, it's amazing how they kind of raise an eyebrow. And again, I think a lot of that is because gold is a misunderstood asset, precious metals are misunderstood, Bitcoin's a misunderstood asset, but it's also just despite all the sophistication, still, and I had in my paycheck in my family office every Monday, return, return, return. was what he said. He was a billionaire, and I liked that mentality. And I kept saying risk, 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 preserve, preserve, preserve. So it really depends on your mindset. I don't think mine is necessarily better than others, but I think we have to, and more people are starting to realize that the secret to making money is not losing it. And one market sell-off doesn't mean we'll have a V-shaped recovery after the next one, especially given the debt levels today. So I think it's a time to be very cautious about risk and about measuring your returns in what I consider a melting ice cube fiat currency, whether that's a euro, a yen, a peso, won, a Canadian or Australian or South African dollar, rupee or ruble. So I just think we have to understand the risks and the inflation risks and the debasement risks, not only obvious but coming, that really do impact your return, whether that's a portfolio or a paycheck.
Wow. All right. Great way to kick this off, Matt. What I take away from all that is we really have this sort of um, twin barrel set of risks that are converging at the same time. We've got a lot of default risk that you're saying, a lot of potential loss risk in kind of the major capital markets, right? You just went through both public and private debt. You talked about stocks, so basically, in the debt market, you've got either a negative real return on your bonds, or you've got the private credit market, and we haven't really talked about this yet, but you kind of intimated it, which is, it's a lot more opaque than the public debt markets, right? Like, we just don't know how many bad loans are being made there, and there's been a huge rush of capital into there of late. I have talked about this a little bit with some of the other people here. So, it's feeling at least like it's rhyming a bit with past manias where there was some new hot solution for capital, but then we find out that, oh, well, a lot of money rushed in there and a lot of it was really poorly allocated, right? You talked about private equity, which has now become, very illiquid. There's big parts of that market now that we're exposed to commercial real estate that not only are liquid, but are getting capital calls now, right? So, I mean, those are the biggest markets, right, where capital goes, right? And you're saying, look, there's a lot of default risk, a lot of loss risk now, to the point where you said that capital is now kind of rushing into other places to find return. And those places, it's often kind of a terra incognita, and they're the really, sketchy parts of town, like the SPACs and stuff that you were mentioning, right? So you take that default / loss risk, and then you combine it with the currency risk. It's that's a bad cocktail, and that's a really tough time for capital's prospects going forward. I can understand, and we'll get to why gold sounds like a really good answer in that type of world. Let's just talk about part of what got us here, and I want to mention a article that I read recently. There's an interview with Neil Kashkari, who's the president of the Minneapolis Fed. Am I getting that right?
I think so. I think,
he was kind of shocked in the article. He said, wow, I've been talking to people, especially those from, like working class people and or folks that represent the working class people. And they're telling me that they would have preferred a recession to inflation. And it was just like a concept that he couldn't grasp his brain around before. And it's just beginning to dawn on him. And I think it's really telling in terms of the way that the Fed sort of sees the world, right? That like, hey, we had to step in and we wanted to keep prices high, and that required some inflation, but we kept people at work, and aren't we great, the Fed, and shouldn't everybody be thanking us? And the workers were like, no, look, we get recessions. It's part of the natural business cycle. We kind of know how to deal with them, and then if we lose a job at one place, we know eventually that we'll get reabsorbed into the workforce, and it's temporary. Where inflation, diminishes everybody's returns permanently going forward. And I think people are kind of waking up. I've been hearing on social media now where people are like, we basically just got like depending on people's estimations, but like a 30 to 40+% devaluation in our currency in the past 4 years that's going to be permanent from here. And it's like, I wouldn't have voted for that if given the option. I totally would have taken the recession.
Well, I agree wholeheartedly with Walt Whitman's observation that the real soul of a country is its middle class, its actual people. You know, Neil Kashkari and a lot of FOMC PhDs don't spend a lot of time with the real people, I don't believe. I certainly don't think Bernanke or Jerome Powell, who said that Fed policy has no impact on the bottom line for the society at large, it's absolutely insane. It doesn't affect wealth inequality. Their policies directly affect wealth inequality. And we could go on that stovepipe for hours. The evidence is overwhelming that the Fed has led to the greatest wealth disparity in our history.
Mm-hmm.
So their policies do matter. Their ignorance is pretty inexcusable. Um, when I go to these fancy places like Istanbul or Singapore or Johannesburg to meet with wealthy people, or London or Wiesbaden or New York, but I'm from the Midwest, and I had a baseball scholarship, and I still drive down Route 80, and I meet real people. I'm not saying they're better or worse, and there's good and bad in every social circle, but they seem to have a far more honest, direct, and almost common sense wisdom than some of the fancy lads that I've met on Wall Street or since then in my life. It doesn't mean I want to romanticize them, but as Gunlak said, you got literally 800 PhDs throughout the Fed system, and they all got inflation wrong. They all did, literally. The transitory meme was, as I wrote from day one, a fiction. Um, and when you talk about inflation, yeah, and Rick Rule said this too, it's not only actual inflation as opposed to the completely fictional reported inflation. It's not only the actual inflation, which is the most egregious invisible tax on the middle class, far more painful than it is on the top 10%. It hurts for the top 10% with their inflation hurdles and their risk return models. For the middle class, they don't have any kind of alternative. They just get paid month to month and live month to month. So that invisible tax is crippling. When you add on the invisible tax of inflation with the actual tax of American taxes, and your net at the end of the year, your bottom line is barely believable. They're the working poor now, and that's not sensational. And that is why the inflation discussion is far more than academic. It is so impactful. It leads to the very type of social unrest that's part of the kind of the demise of any empire or any nation or any hegemony over a period of time, which we're in. We're in a clear cycle. The Fed is, and Neil Kashkari, I'll add him in the mix, and that includes Lyle Brainard and all of them, including former Fed officials that are now Treasury secretaries. They're magicians. They really are, and they're far more interested, in my opinion, in their resumes than they are in being fiduciaries to their nation, and that's an evil thing to say. But look at their actions, not their words. They're intentionally wonky on inflation. Let's start with the first obvious thing that everyone on Wall Street knows. You know it, I know it, I think all your listeners know it, that the BLS, Bureau of Labor Statistics, definition of inflation, the metric of inflation, is fiction. It just is. And to get into the details of that, even Larry Summers, the former president of Harvard and assistant Treasury secretary, even Larry Summers, who's now trying to revive his personal appeal, has admitted that if you use the pre-1980 metric for housing, the actual inflation today would be probably 17 to 18%. Now, John Williams at Shadowstat says it's more like 8 or 9%, but we certainly know that the 3.5% is a made up number. Literally, what the Bureau of Labor Statistics and the Fed want it to be. We all know that inflation is much higher than that. And when they were in Jackson Hole in 2020, and they came up with that, what was it? Supercore inflation. Another way to get around the CPI number, supercore inflation, was inflation, which is X food, energy, and shelter. And then you had Paul Krugman in the Wall Street Journal 2 weeks later saying, we're going to hit 2% with supercore inflation. Yeah, you take out everything that Americans need to survive. And the price level that was just horrifying.
Yeah.
And since then, they've tried to do
and
other
insulting,
tricks.
right? I mean,
It's
insulting to
insulting.
anybody reading this, comparing
It's
it to their
insulting.
lived experience. Yeah.
It's insulting. And since then, the Fed's had other tricks, headline, CPI, X shelter, or then they'll try and do 3 to 6 month average numbers, but that actually made inflation worse. They stopped doing that. So and they're missing the dispersion, the scale. We've used the fat camp analogy in the past, where they say you're getting thinner though you're eating more beer and pizza. They just don't measure beer and pizza. But if you look at how the dispersion, if you get into the details of the CPI, they'll say, well, auto prices are down 6%, but they'll ignore that auto insurance is up 20%. So that's a 26% different range. By the way, insurance everyone needs to have if they have a car. And they need more insurance, and the price is up because there's more crime, because society is more splintered, and because they're more broke. So you've got that. Then if you look at things like assisted living or financial services or healthcare or food or shelter, they always go up. And the most important thing to understand about inflation, which I think the man on the street feels, even if he doesn't have the time to dig into the weeds of the BLS data, which is in Rome, it's the hieroglyphics. But the inflation rate is a rate of change, not a price level change. So even if we go from 9% to 6% to 3%, that doesn't mean prices are going down. It means the rate of change is going down. But that prior 9% is still there. It's compounding. That prior 6% is still there. It's compounding. In other words, the price of things is definitely going up. Inflation, as you feel it at the grocery store, if you're paying college tuition for your kid, God, good luck. God bless you. That's hard. If you're paying private school tuition for your kids, I've been there. That's hard. But if you're just trying to get through groceries, rent, car payment, insurance, and you have a little bit left over, congratulations. But you know, without the official CPI data or BLS data, that inflation is very sticky. And for the Fed to deny that is amazing. But what's even more amazing is a recession would be better, to your original point, than this invisible tax, this slow death by 1,000 cuts of the dying purchasing power. At the same time, and I'll say this and I'll finish with this, I'll stick to this thesis. I'm one of the few who has it. I believe, and I'm not alone anymore, that if the Fed's war on inflation is pure politics, pure optics, they need negative real rates. They will have negative real rates. They need inflation to be higher than the yield in the 10-year or the official Fed funds rate, because it's one of the only ways they can do to inflate their way out of debt. That has not changed. We're not raising rates to fight inflation. We're raising rates so we have something to lower when the recession that we're denying becomes official. And so there is an intentional inflationary endgame here. There's an inflationary policy. That's what all debt-soaked nations throughout history, without exception, have done. We're just lying about the inflation to the people, even though they can feel it. I know that's sensational, but the CPI scale is, I'll say it again, it's as bogus as a 42nd Street Rolex or a Louis Vuitton purse you buy on Third Avenue. It's fake, but it's never right, but it's always correct because it's the official number. Meanwhile, we're suffering from this inflation. A recession would have been better, but we're going to see more inflation. That does not mean that we won't have massive disinflationary or deflationary forces in the interim, like a recession or potential market correction or a serious downturn in the markets. Those are very real possibilities. But the only way to pay for our unwanted, unloved IOUs, which are globally unwanted at an empirical level, is to buy our own debt. And we'll do that through a number of tricks, not just QE, and that is inherently inflationary, and that is the end game in this game. And the inflation is going to hurt these people in ways that are already palpable to many listening right now.
Well, number of things to say about that, but the one that sticks out most in my mind is, I think since the last time we talked, Matt, I was able to interview Thomas Honig, who used to run the the Kansas City Fed, and then quite famously served on the Federal Open Markets Committee in the Bernanke era, and set a record for the longest string of dissenting votes when Bernanke was trying to get everyone to be unanimous about doing QE. He was warning about all the things that you and I have warned about for many years,
God bless
and
him.
of course they've come to pass since. And it was a really important discussion because we so often are trying to, determine, guess, make our best guess about what the Fed is thinking and what's going on in there, where Honig actually sat in the room of power and was involved in the decision-making process. And
Yeah.
he was very kind in answering every question I asked him very directly. He didn't mince his words at all. In a lot of ways, I left the conversation a lot more depressed than at the beginning, because I was kind of hoping that there was some good news that maybe he knew that I just hadn't
Yeah.
seen. And he validated a lot of my concerns,
Yeah.
and I imagine they're your concerns too.
Yeah.
But at the very end, I asked him about um, the what he thought the future of purchasing power of the currencies were, because they've been getting diminished by central bank policy rates. And he said, sadly, this is one of the things I'm most confident in predicting, and that the future purchasing power of fiat currencies is going to continue to diminish,
Yeah.
and probably most likely at an accelerating rate, right?
Yeah.
So I know that's not necessarily any surprise to you, but just to hear that really come from the horse's mouth was like,
Yeah.
wow, okay. Um,
Yeah.
so we have this need for inflation at the official level, you're saying, right? Because the debt pile is growing so much, they need to inflate away the cost of servicing that debt. So, to a certain extent, you're saying, look, we need to expect some inflation going forward. I'm assuming you're saying we need to expect lower rates going forward as well because they need the negative real rate, and because a highly indebted economy just can't tolerate high rates for very long. And where I'm going with this question is okay, so we're now at the point where, we're adding $1 trillion every 100 days. In fact, it might be fewer than 100 days now. And so that's very scary. The debt service cost at these higher rates nationally is now higher than any other expenditure except for Social Security. So it's even past defense, right? Um, what are the implications of this? I mean, at some point, we've got to be getting to a point where the Fed has to say, look, we got to start somehow mitigating the pain of the current debt service at these high rates. But of course, at least in the near term, inflation has been staying their hand. So how do you think in the relatively near term this plays out? And by relatively near term, I mean 6 months to sort of 2 years.
As I said at the beginning, I want to try and give both sides of the argument and then give you my view. So it doesn't look like I'm just talking my bias, because I think there can be a strong case made for rate cuts coming or no rate cuts at all, or possibly even higher rates. I think what's interesting is it almost doesn't matter because the end game is still inflationary.
Yeah, yeah.
But
I think we're clear on your
yeah,
picture of the end game,
yeah.
which I share, but yeah.
The argument for rate cuts is fairly simple. By the way, Powell himself has said he'll probably do 2 to 3 rate cuts this year. At the beginning of the year, everybody was talking when you and I were in Vancouver, 6 rate cuts this year, and we were
Right.
kind of sanguine about that. But even Powell, depending on what he says versus what he does, has openly said he would look at rate cuts this year at least 2 to 3 times. If you translate FOM speak, the reason you would make that strong case, and many, including Jamie Dimon, Jeffrey Gundlach, myself, and others would agree, and it's very simple. We're looking, if we stay at the current rate policy, of the interest expense on our debt this year being 1.6 trillion, which by the way is higher than our military budget. And as historians have shown, the moment your interest expense on debt surpasses your military expenses, it's no longer fable but fact that you're in a broken country. So if we don't cut rates, we're looking at 1.6 trillion in interest rate expense alone. That would be a strong case for rate cuts. But a couple 25 to 30, 40, 50 bip rate cuts isn't going to really build up much of a dent, even if he did do that. It would certainly be a tailwind for equity and for equity markets and bond markets if we did rate cuts and even a little bit of real direct QE. The other argument against rate cuts is we still got to get target 2% inflation. It's the most important thing on our mandate, and we'll do that. And by the way, I don't want to make the Volcker mistake of 1980 when we thought we beat inflation, we cut rates dramatically, and then inflation spiked by 8%. And Powell has his legacy and his ego because he's not above that to think about. So those are the two cases, pro and against the interest rate hike. But to my opinion, to Luke Groman's opinion, others, it almost doesn't matter. Not just because either way the end game is inflationary, but the real problem is fiscal spending is going to be the real gut punch to us. And because we're going to be going deeper and deeper into debt in an election year, after an election year, given the problems we have fiscally, our trade deficits and our budget deficits are 3 trillion a year. The CBO has already announced another 20 trillion in the next 10 years. It's incredible how bad their math is. We can get into that too. But the simple fact is we're spending far more than we're getting in tax receipts and GDP. So we're going to put in liquidity. Whether we cut rates or not, we're going to see massive inflationary forces, which again may be counteracted by a disinflationary market crash or an overt recession. But the type of liquidity that's going to be necessary to pay that interest expense and to cover those deficits, which are not slowing down. I mean, again, you could say we could cut entitlements or military spending by 50%. You could say we could let IOUs default, 10 years default, or let bonds be restructured. That's possible. But failing that, we're going to see more liquidity. And liquidity is always inflationary. And everyone says, well, there's no QE. But believe me, there's QE everywhere. There's liquidity everywhere. And it started in 2019 when no one noticed. It was a huge event for me when the repo markets failed in September 2019. The Fed was bailing out the commercial banks because they didn't trust each other's collateral. And there was hundreds of billions being pumped into the banks in September 2019. But you fast forward to 2022, 2023, entering the TGA accounts. We did the BTFP program to bail out the banks. That was not a bank failure. That was a credit failure, a liquidity failure, a bond failure. after the BTFP, then we started doing other tricks to get reverse repo liquidity. And then after that, now we have this, it's a fancy Wall Street term, these supplementary leverage ratios, which all it is giving commercial banks, Fed banks, unlimited leverage to buy US debt at a 0% borrowing cost for a 4% coupon. But that just means that the banks are basically doing QE for the Fed. They're absorbing those unloved, unwanted US treasuries. And in addition to all that form of backdoor QE, you've got Basel reg changes coming up this week that could allow for more liquidity into the banking system. And even Freddie Mac is talking about guaranteeing second mortgages so people that are already in debt can go out and get a jet ski and more debt and a credit card paying an average rate of 23% interest, which to me is grotesquely, usurously illegal, but allowed. So in other words, liquidity is there. It's not in the form of direct QE. It's off the balance sheet of the Fed, but it's there to sustain deficit-driven growth, which is debt-based growth, which is not growth. It's an oxymoron, but it buys time. That's what's so dangerous about Western versus when I'm in the East, talking in Turkey or talking in Asia. The mindset of the West is buy votes, buy time, buy excuses, finger point, but keep solving a debt crisis with more debt and then solving that with artificial liquidity, which is inherently debasing your currency, which is inherently inflationary. And that's the trap we're in. That's why it comes down to a currency crisis at the end, regardless of how they discuss liquidity. They discuss the mechanizations at the Fed, QE, QT, rates up, rates down. There's all kinds of hidden cracks in the liquidity ice around it that's providing liquidity, which is just buying time. It's avoiding that recession. It's avoiding that constructive destruction that the middle class thinks is actually better than inflation, as you said. It's postponing that to buy political time, buy political votes, and really make excuses. It's absolutely adding more and more kerosene to the Folger can with that debt match getting closer every day. And so it's fascinating, the short-sighted political gamesmanship, excuses, and trickery, and intentionally complex, wonky things like supplemental leverage ratios and reverse repo markets and Treasury General account liquidity. It is so wonky that no one, including half of the FOMC, understands it. And I'll just remember, I was watching Biden's chief financial advisor try to explain QE. He was 100% wrong. That was another leading indicator of, the emperor has no clothes, left or right. I'm sorry, I'm not trying to pick on Biden, but his chief
Yeah, and for
financial
those that,
advisor.
that didn't see that clip, I mean, he even admitted halfway through, I guess I don't understand this.
That's unexcusable. Stupidity is an excuse when you're advising the president of the United States, who's then supposed to be part of this relationship with an independent Fed, which is now the fourth branch of government. And again, we could spend hours on how wrong that is and all the historical implications for how unconstitutional it is and what Woodrow Wilson did and what Jackson and Jefferson warned. But it's already happened. We're now in a place where the sins of our central bank, the sins of our ignorant advisors and our PhDs are no longer able to be denied, and that you're not a quack in your mother's basement doing Google searches once you see this. I was helping a young woman yesterday in Paris. She did a Zoom call. She's a PhD candidate. She's writing about de-dollarization and central bank policy. And she was literally extraordinarily fascinating because she understands these things. And she's such a minority to understand these things. And the more she understands these things, the more difficult it gets to believe. And it is depressing. Like your central banker Honig's example, it made you depressed when you actually see how the sausage is made. Again, it's not sensational. It's just too much debt solved with more debt, paid for with money created out of nowhere, mouse gets out of nowhere, and provided through all these backdoor channels to buy time. And when things get really, really bad, what the professionals will do, the experts, the ones with the little flags on their collars and went to good schools and have PhDs, they will blame it on something else. They'll blame it on a COVID virus, an hysteria, a fiasco policy. They'll blame it on Putin. Again, they'll blame it on wars that they said they didn't start, and they'll blame it on potential foreign invaders from outer space. Anything but their own accountability. It's almost impossible to find a politician or a central banker or even a commercial banker who will say out loud, boy, we got that really wrong. They're doing the Chris Cuomo dance, totally wrong on something, but unable to admit it. That's a fascinating psychological part of the history of finance and the history of money. But no, rate cuts, rates hikes, doesn't matter. There'll still be liquidity through the back door. They'll still be buying time. They'll still be debasing the currency, and they'll still be looking for negative real rates, even though they'll misreport inflation the whole time.
All right. Well,
There's
Matt,
no
no,
way around
I
it.
mean, I know you're a student of history, and I was just talking the other day um, with uh, an investor who was basically saying, he sees a lot of repetition in what's going on right now in the markets, and he said it's just amazing. He said, we just the people never learn. He said, the story is always a little bit different, but
Mhm,
the mistakes that people make really never change. And we were talking
mhm,
about how, there's that old saying that we have um, space age technology, we have medieval institutions, and we have basically Stone Age human neural
mhm.
wiring, right? That
Yeah,
that part just
yeah.
hasn't changed, right? And so, history has had a lot of uh, economic and monetary regimes that have come and gone. Listening to you, it's very hard not to get the impression that, this is late stage, empire
Mhm,
collapse dynamics that we're seeing here, where
mhm,
basically they're just using every trick in the book
mhm,
to try to keep the status quo going on for at least a little bit
mhm,
longer. And if they've got to steal, maximal uh,
mhm,
prosperity from tomorrow and pull it into today, they will. And I think the general human nature of this is if you're in a position of power where you're benefiting from this, it's let's just keep it going just a little bit longer, just until I get out of here and it's someone else's problem, right? So you're
yeah,
nodding as I'm
yeah.
saying all this. So I want to talk about mindset, because we'll talk in a moment about how there is quite a big difference right now between the West and the East when it comes to gold as a
Mhm, mhm,
solution.
mhm,
I was just talking to Ronnie Stafferly, did an interview with him
mhm,
a week ago
mhm,
because he just came out with his,
mhm. Gold We Trust
epic
report.
annual In Gold We Trust report.
Mhm,
And his research shows that when it comes to the bullion market, about 70% of the buying is coming from China and India and the Middle East.
mhm,
And when you look at the uh, the Western market, you're definitely seeing a real kind of disinterest, certainly a huge lack of interest in the financial buyer from Wall Street
mhm,
in gold,
mhm,
right?
mhm,
Which
mhm,
is kind of interesting
mhm,
because Wall Street loves momentum and gold's had really good year plus behind it here.
mhm,
But still, if you look at capital flows going into the precious metals ETFs, it's really showing Wall Street really doesn't care
mhm,
right now about it. And
mhm,
so, we sort of have this mindset right now where the East seems to say, "Hey, look, we'll take gold all day long, at these prices. Please sell it to us." And the West is basically taking a short-termerism opinion, which is like, fine, yeah, if I can get bucks from you today for this, this
mhm,
barbarous relic, sure, take it from
mhm,
us. Now, you've
mhm.
said several times in this conversation that you've been traveling the world, been talking with a lot of different people. You have seen when it comes to currency or monetary policy, you're saying you're seeing a real difference of thinking between those you talk to in the East versus those you talk to in the West. Tell us a bit about the differences that you are seeing there. What are you hearing from people in the East that you're not hearing from those in the West?
Yeah, it's fascinating. And again, even Ronnie is different than the West because Ronnie's an Austrian from Vienna, which is on the border of the East. And Ronnie was educated in the Austrian School of Economics, not the Keynesian School of Economics. And Ronnie's a great friend and he's a brilliant, brilliant expert, not just on precious metals, but on credit markets and currencies and the history of markets. And he's written some great books. I think they're in English, but on Keynesian and Austrian economics. So even Ronnie is a good starting point without, believe me, I don't want to live in St. Petersburg or Beijing. I'm still very much in favor of Paris and New York or Virginia specifically. I think there are beautiful things about America, but we are the product of our environment. We're the product of our schools, we're the product of our cultures, we're the product of our parents, we're the product of our Fed and our White House. And we're certainly the product, if we're in Wall Street, of our MBAs and our jobs. And if you understand Wall Street, if you spend any time there, or you understand the private wealth management industrial complex or the RIA industrial complex, it's profoundly groupthink, consensus think, rational thinking, but trained in the way of looking as everything as rate of return, risk management, diversification, all the key buzzwords we learn, risk adjusted returns. Americans and American family offices that are run by CIOs who are usually a managing director at a large American commercial bank with an MBA from Stanford or Harvard or Penn or Wharton or whatever think very similar. consensus think. It's not necessarily stupid think, but they were never, because the commercial banking system and the Wall Street system is tied to the Fed and DC. They were never educated on gold or Austrian economics or currency risk. They were educated on getting the best return on my leverage with little downside risk, hopefully. They never thought about gold because no one wants you to think about gold. Ronnie would tell you about a book, I think it was called 6 Days in August, when it went off the gold standard. What was the Fed's biggest concern? The gold price. What's the gold price doing today? We've just gone off the gold standard. What's the gold price? Because if the gold price goes too high, that's an embarrassment to the US dollar and US policy. Of course, then they had the COMEX market and the petrodollar to save that problem within 3 years. But I'm saying banking in general and Wall Street in particular intentionally misunderstands gold. And I'm going to get this because it's the East doesn't. The East is the old man or the old woman. And the West, in the US, is the young adolescent with that new Ferrari and that Ferrari appetite. We're educated that way. That's the American dream, success. It's a very twisted notion of success. But the American dream and the American mindset, the American bank, and the American understanding of gold is infantile compared to the East. And again, that may sound condescending. We don't think about gold because we're not taught it in school. We're not taught about Austrian economics, constructive destruction, or about currency debasement because we're taught about rate of return. And that's what we're taught. And the banks don't talk about gold. Banks can't hold gold and leverage it the same way they can with credit instruments or even your deposits post Glass-Steagall. Banks are about leveraging. They've become hedge funds thanks to Larry Summers and the repeal of Glass-Steagall and thanks to derivatives. Banks aren't thinking about safe investments. And gold, to them, there's no money in gold. Also, gold is something they don't want to talk about because it's anti-dollar, anti-Wall Street. It's the anti-narrative. It's the risk protector. And Wall Street's really about risk and fees and leverage and hypothecating and double leverage and multi-leverage. So you won't hear banks at Barclays or Goldman or Morgan Stanley with the precious metals expert. They'll have a commodities team or a commodities desk, and they'll use that to hedge equity risk or look at equity and commodity cycles. They'll never talk about gold. It's not a conspiracy theory. It's not even cognitive dissonance. It's not part of the narrative. There's no money to be made in putting gold in a hole in the ground and staring at it for a small fee, which is what we do. But in the East, they're not adolescents. They're these older men. When I talk in Turkey or in Asia, and then whether they're Iranians or Chinese or Turks or Singaporeans who've gone generations through different cycles, they've been watching America with bemusement. We love a lot of things about America, and there's a lot of things to love about America, including Wall Street and the glamour and the return and the equity markets, and its bond market is more regulated, and there's great opportunities there. Japan certainly loves to use the S&P to put their net international investment positions. I'm not saying America's stupid or wrong, but they don't understand money. They don't understand real money, and banks potentially don't understand real money. But when they say, well, Russia and China and even Japan now, they're going to plan B since we weaponized the dollar. They're saying, no, it's not plan B. It was always plan A. We've always been watching and waiting for America to get over its skis in debt and for that world reserve currency, which was the tail wagging our dog for generations, certainly post World War II. The dollar was king. The dollar was king. It was gold backed for many years, 30 years. And we knew they were the world leaders. So when they raised rates or they cut rates or they inflated or deflated, we had to move our currencies along with it. Russia and China are not, again, Venezuela and Iran. You can't sanction a country like Russia without consequences. It wasn't plan B to create currency swaps, a Shanghai Gold Exchange, a BRICS alliance, which we can talk about. It's very, very interesting. It isn't even a plan B to slowly wean themselves from the petrodollar. It wasn't a plan B to net settle in gold. It wasn't a plan B to have 45 countries trading outside the US dollar. It was plan A, but you had to wait because they're playing chess. America plays checkers. You had to wait until America became a debt-soaked nation, a classic empire reversal. Not overnight, slow and steady. So the plan B is really plan A, slowly, not replace the world reserve currency, not have the ruble or the yuan as the world reserve currency. They don't want it. They just want sounder money. And they're waiting and they're watching America slowly implode, not disappear. This happened to the UK. This happened to the Dutch. This happened to the Habsburg in Spain. This happened. Empires rise and fall. They don't disappear, become extinct. They just lose their power and respect and influence. And historically, a great currency, like a great nation, like a great army. This is the anniversary of Cold Harbor in Virginia and Robert E. Lee fighting Grant at Cold Harbor. Great armies don't die easily. The Army of Northern Virginia didn't die easily. The Wehrmacht didn't die easily, despite all the losses in Russia. Napoleon didn't die easily, despite all his victories. And America's currency and system of markets won't die easily. It'll just change and get slowly weaker. And Eastern investors who do own gold, uh, they own it for the same reasons that our investors in Switzerland do. They're basically seeing that they're basically seeing something that Americans have a hard time understanding, that it's not that the dollar is being replaced. It's just going to be repriced. In other words, it's going to lose value. And when they say you don't invest in gold, you hold gold. And the reason you hold gold is you save in gold and you spend in fiat money. But that gold is your chunk. And if you need to carve a little bit off to buy a house or a wedding for your daughter or real estate, you obviously have to convert that into a liquid currency. The US dollar is the most liquid currency, but you want to have that when you need a little bit of that currency, you want to have it the highest valuation. Gold holds its value more than any fiat currency, including the US dollar in the long term. So they understand the world reserve currency isn't going to change. It's going to be part of settling trades. But if you want to preserve your wealth, of course you need to own gold, large amounts of gold, because it holds its value over time. And that's not sexy to the Wall Street Western mindset, to the mindset we came up in the banks or in the private wealth management industrial complex. We're all about getting more and more return. But again, we forget that I've seen families rise and fall. I've seen fortunes rise and fall on a relative basis. It's not a joke that the joke in the family office space is if you want to manage a small fortune, start with a large fortune.
Mm-hmm.
Because that third gen usually doesn't have the sophistication. What I found in the East, and this isn't entirely true, they're used to watching things go up and down. They're used to suffering. They're used to cycles. They've studied them more. Again, I don't want to live in Moscow or St. Petersburg or Shanghai, but Moscow and Shanghai citizens have seen history move, and they've watched the West from afar. They respect a lot of things about it, but there's nothing to respect about our current financial, monetary, and even domestic and foreign policies, in my opinion. They see it much more soberly. They see this as that late stage empire, that debt, war, decadence, currency debasement, social unrest, and then opportunism and blame, and sadly, war. They've seen this movie before too. Americans have a hard time seeing themselves from inside themselves. And that's what's interesting about being an American who's lived most of his life in Europe, but travels through Asia and other places. I don't lose my interest in America or my faith. I still think I'm a huge patriot, but my perspective of it is very different. And I I do learn lessons. And Ronnie Sturfula has a perspective of America that's very admirable, but he has an Austrian economic understanding that you can't, as von Mises said, you cannot have a debt expansion at this level without debasing the currency. And debasing the currency isn't an intellectual or academic phrase. It's felt at home. It's felt in the homes and the houses and the streets of the country. Anyway, I'll just say that I'll finish with this thought that the idea of currency debasement that von Mises talked about, that the Austrian school talked about, it's not just an academic construct. Currency debasement, inflation, however you want to phrase it, is more than an academic term. It means that you can't help your kids go to the right school. It means you can't cover rent. It means you may not be able to have the future you wanted, not because you did anything necessarily wrong, but because the system that you believed in, that you elected, debased the currency because they were too busy going far beyond their means and debt. Families, individuals, and companies, typically, if they're soundly run, don't spend 3x what they earn. They don't take out more debt. They don't lever that debt. And then expect a good synopsis. A father, I would not join a polo club in Zurich or Geneva or Paris and play every weekend and drive a nice car there and spend a fortune on horses and lunch and dinner and champagne and then leave the bill to my grandkids. I would never do that. That may make me look popular at the polo club, but if the net result was I was making my grandkids pay for it, no one would visit me at the cemetery. In other words, who would honor that grandfather? Why are we honoring a government that keeps kicking the can to the next generation so that they can stay elected? Or in Bernanke's case, as Hernig would probably agree, so he can win a Nobel Prize for solving a debt crisis with more debt and then paying for that with money Mouse gets out of the Eccles building. That's not noble. That's not Nobel Prize worthy. But again, the East sees this differently than we do because we're too busy distracted in the latest meme stock or the latest NVIDIA that's going to save us, or the latest Fed governor who's going to tell us not to worry about inflation, or that we've got things under control, or we're going to restructure this debt. Uh, I find that fascinating. And again, currencies, governments, like great armies, they don't give up easily, even when the math clearly shows that they've had their Gettysburg moment, they've had their Waterloo, they've had their Stalingrad. They're going to lose. America and the dollar is going to lose one way or the other. It's just whether it's fast or slow. And I think it's going to be faster than people realize. It doesn't mean gold will only go straight up. It doesn't mean the dollar will only go straight down. There's a lot of nuances there, but it's very simple. We're way too in debt. We don't have the productivity to pay for it, and we're not taking accountability for it. And the austerity that's necessary to reshore manufacturing, to reshore jobs, is brutal. And the only way our country would support that type of austerity is if they trusted their leadership. I don't think there's a lot of trust right now in leadership in a very divided states of America, a very tribalized United States of America. There isn't a politician, who can tell the truth. And the truth is, Americans, like many citizens of the world, like to hear sweet little lies, like romantic partners. They want to believe what they tell you. They don't want to hear about austerity, debt, inflation, recession. Melee in Argentina could say it because by that point they were already on their knees. That country was overtly broke. It is impossible to imagine America like Argentina, and it won't be because it's home of the world reserve currency. But you need that kind of blunt leadership, and you need a population that believes in it, that asks not what their country can do for them, but what they can do for their country. It's hard to do that, whether it's Biden or Trump in the White House right now. We're too divided. We're not going to galvanize and follow a leader necessary. And I don't know if we have a leader brave enough to tell the world and their country and their citizens how much we screwed up over the last 60 years.
So Matt, I could take probably like a dozen different threads there and run with them with you for the next couple hours, but we're approaching
I
our
know.
hour
Yeah.
mark here, so we're going to have to start
Mm-hmm.
wrapping it up. But on that last point, I've said many times on this channel, human nature being what it is, we are highly likely not going to collectively uh, agitate for a different and hopefully better path until the pain of change, or until the pain of continuing the status quo, gets to the point where it exceeds the pain of change, right? And that's just
Yeah.
Americans, sadly, and then probably many people, right? You don't change
Mm-hmm.
your lifestyle, your diet until you have the heart attack, right? And then that's your
That's
wake
right,
up
right.
call, right? So like I
Sure.
do think we probably will start addressing that stuff, but it's probably not going to
Mm-hmm.
be until things
Mm-hmm.
get worse and maybe even a fair amount worse before we're willing to say,
Mm-hmm.
hey, wait a minute, there's got to be a better way to do this.
Mm-hmm.
All right, well, look, real quick, just before we hop off this topic of the difference between the West and the East mentality, I did just want to show this chart, which is
Mm-hmm. Yeah.
I grabbed it from Ted Oakley's presentation, but
Yeah.
you mentioned this earlier that the world central banks, largely driven by those Eastern countries, are
Mm-hmm.
essentially trading gold for U.S.
Yep.
Treasuries right now.
Yep.
Definitely reflective of the mind share that you're talking about. Is this something that is a permanent trend
It's very
here?
important.
Very
It's a very,
important. Is it a
it's not,
permanent trend? Don't know. May they start resuming the treasury purchase at some point in the future? Maybe. Obviously, you've got better perspective on that, having talked to these folks.
it's going to be very hard to imagine a world repurchasing treasuries or dollar denominated bonds when we are so over our skis in debt. We're like a bad credit with a declining asset. I mean, gold is replacing, as that graph shows, the U.S. Treasury as a reserve asset. It's a savings asset. The U.S. dollar is a spending asset, and they save in gold and spend in dollars. But the world wants an asset that can't be taken away. In other words, it can't be weaponized. That was a huge mistake in 2022.
Mm-hmm.
Whatever your politics on Zelensky or Putin, I'm not here to debate that. That was a that was a neutral reserve world currency that we weaponized against a major world nuclear power with a relatively intelligent statesman at the helm. Whether you like Putin or not, he's not stupid. He can finish a sentence and can walk a straight line, and he can think historically. Doesn't mean I'm pro Putin. I'm just saying the world wants an asset that can't be taken away. And that explains why the de-dollarization among the BRICS is not a headline, but a reality. It's not fable, but fact. And they want commodities in general and gold in particular. And I'm not saying this against, but they're not buying Bitcoin. That's not a reserve asset. That's not a medium of exchange. It's not a store of value. A Bitcoin can go up and down so dramatically in price, at least for now. That's not the answer. I'm not anti-Bitcoin. I'm just saying right now, they want commodities to net settle their trades. They trust commodities in general and gold in particular more than they even trust each other among the BRICS. But the simple fact is, when you see that type of dramatics, again, since 2014, this was even pre-sanction. That's why I don't think this is plan B. When you see central banks stacking gold It's because it's like an army preparing for the other army coming near the border. They
Hmm.
see the pickets and the soldiers and the cavalry and the tents and the cannons, and like, okay, it's not going to be a hot war. It's going to be a currency issue. It's going to be an economic issue. We need to get ready for a new reserve asset. Gold has been a reserve asset many times throughout history when economies break and there's a new system. I don't think the ruble is going to replace the dollar or the yuan is going to replace the dollar, but gold is going to net settle. It's going to be a net settling trading currency, and it's going to be a reserve asset. It already gets a better return than U.S. Treasuries. So nations are trading gold the same way our clients do, as a reserve asset, not as the only asset they own, but as the way that they save their money. When they need liquidity, they'll call our broker desk and convert it to euros or Canadian or US dollars when they need to buy something. But they're going to save in something they trust, something with a finite supply and an infinite duration. A US Treasury has infinite supply and a finite duration, but it is no longer trusted, not only because we weaponized it, but because we debt soaked it. And we're
Hmm.
going to create more of those IOUs, and we're going to effectively buy our own debt through a number of mechanizations, not just direct QE, but all the things I mentioned earlier, all those tricks from the TGA and the reverse repo to the SLRs. We'll be buying our own debt. We'll be debasing our currency. Why would you want to own as a safe haven asset an IOU from a country that's that in debt with a currency that's that debasable, even if it is the world reserve currency? It's simply going to lose more and more of its purchasing power. And again, since 1971, like all fiat money, since we've got off the gold standard, even the US dollar, when measured against gold, has lost over 98% of its purchasing power. That is a hard fact. That doesn't mean gold always outperforms the S&P or that gold always outperforms the US or the DXY. It just means, and I'll use that other graph I sent you, if you bought a house in 1920 with 250 gold coins, 250 ounces at $20 an ounce in 1920, it would cost you 5,000 to buy the average US house. So that would take 250 coins. Well, if you fast forward to 2024 and you had that same shoebox of 250 coins, you could buy a $500,000 house, which is the average median price of a house in America. But if your grandmother gave you $5,000 in a shoebox from 1920 and you use that today, it wouldn't buy you the landscaping in that house. But if she gave you that shoebox of gold coins, you could still buy the average US house. That's what is important about gold to understand. It doesn't make you rich. It preserves the purchasing power. It buys things for you that dollars can't over the long run. And if you're a legacy investor, not a speculator, if you're a family office or you're a sophisticated investor who has enough wealth, you're thinking not just 10 minutes ahead. Ronnie Sturflick gave a great lecture about this. You have to be thinking generations ahead. Americans think about the next sweet car if they have money. And if they don't have money, sadly, they're thinking about just how to get to rent. And I respect that. But I think this mindset of understanding the purchasing power, not the sexy SPAC like returns or the NVIDIA like returns, the opportunity costs and all these risk assets. Understand if you're really trying to measure your wealth, you want it in something that holds its value over the centuries. Again, a shoebox of gold coins will buy you a house anytime in the world. A shoebox of dollars will not buy you the same house 100 years, 50 years, 60 years later. It's a melting ice cube. Those dollars may be made out of paper, but they act like ice cubes. That's not fable, but fact. It's hard to understand that. It took me a long time to figure that out after chasing bond yields and sexy hedge funds and allocations and 2 and 20 fee structures and talking to PWMs, smart guys at all the banks who could talk derivatives to the point where I got confused. It was all smoke and mirrors. I just want to preserve my wealth. If you're a speculator, there's other places to go than gold. But ironically, gold has outperformed the S&P, even a total return S&P since the turn of the century. But that's not why I own gold, or why you should, in my opinion.
So I agree with that, but I do just want to ask this question because I mentioned earlier that in the West, the investment world is quite disinterested in it still.
Mm-hmm.
Um,
Mm-hmm.
you buy gold for the purchasing power protection, but does gold have a speculative optionality baked into it? Meaning, if the Western financial world does wake up and say, "Hey, wait a minute, this is something to be in," um,
Mm-hmm.
it's the precious metals market is not that big of a market, and so even if just a
No.
percent of two of capital comes over from, say, the bond market, which, as you said earlier, kind of locks
Yeah.
you into
Yeah.
negative
Yeah.
real yields. I mean,
Yeah.
that could really catapult the gold price a lot higher, right?
Look, let me be clear. I
It's
was a
not the reason to buy
speculator.
it, but
No,
it's
no.
yeah.
I am not some, let's be real human, all too human. I was a speculator in my late 20s, and you and I came out of school, and you remember San Francisco and the dot-com bubble and all
Bananas.
the
Yeah.
Robbie Stevens and the IPOs. And of course, I was a bold speculator. So I'm not poo-pooing speculation or the great American desire to get a nice 10, 100, whatever, 20 bagger. I'm not laughing at that. That's what put me in the position to then have the high class problem. How do I preserve it? So I'm not mocking speculation or saying you should only invest in gold. And there are risks to gold too, which we should talk about. I am saying, look, it's intentionally misunderstood on Wall Street. It's unintentionally misunderstood because we're not taught about it in Keynesian business schools or undergrad economics. But look, you're right. Family offices, 1% allocation to gold. Of global assets around the world, gold right now makes up about 0.5, 0.6 of all global allocations. That's staggering to me. I feel very much a part of either a very small or delusional circle. I think we're pretty smart. Our clients are pretty smart. I could name their names, but I can't, but they're pretty smart. And you'd be surprised who they are and where they come from. But what I will say is the 40-year mean for physical gold allocations is actually 2% or 4%. Actually, it's 4%, and it's gone as high as 6%. But if you take the 40-year mean of 4% and your current allocation of 0.5, if we just revert back to the mean of a 4% global allocation to physical gold, that's
It's eight
what,
times.
0.5. Yeah, it's 8 times. If we go to 2%, that's 4 times. So gold has a lot of reasons to be going up. It doesn't mean in a straight line. But when the world understands gold, it's usually when there's quote unquote blood in the streets and chaos, sadly. And that doesn't mean I'm looking for chaos. I see signs of chaos everywhere right now. I think we all do. It's very subtle, but very real. Gold steps in, but it still preserves its purchasing power. Now, um, I think we're going to see, I don't know, we're not going to see a gold backed dollar. We'll see gold having a higher role in its percentages and coverages if we lose faith in gold. But if even we have a 20 or 40% official or unofficial gold coverage in our World Gold Council reports, I think gold has a 6x, 7x return just on that metric. But that's wonky too. I also want to say, so people think I'm just selling my book and that all you need to do is buy gold. It doesn't solve all the problems. I think gold is going to go to double digits in very much in my lifetime because currencies are going to get continually weaker. They've gone weaker ever since I was born and before then.
And sorry, when
But
you said double digits, you mean 5 digits, right? 5 digit gold.
oh yeah, but yeah, double. Yeah, I'm sorry, 5 digits, at least 10,000. I do believe that. I think that's minimal. That doesn't mean gold can't go down even significantly. There's a guy from Denmark, I think Henrik Zaberg, who thinks gold could actually go down to 1250 if we have a market crash because, like 2008, everyone needs liquidity. They sell their gold.
Yep.
They need dollars. Uh, silver ETFs are going 800 or 400 billion in outflows. That's just because there's more physical delivery. But I'm saying there is a case to be made that even gold can see a major price swing down, especially in a major market implosion. I'm not saying gold is going to solve every problem. You should be 100% in gold and you shouldn't speculate and you shouldn't look at other assets and you shouldn't, go for it like you and I did in the 90s during the dot-com bubble. Be very, very careful because not every ending is happy in those stories. You can be lucky more so than you can be intelligent. You confuse that luck. But if you have wealth or you have enough to try to preserve, you can't ignore gold. But I don't want to say that gold only goes up, but I don't see right now a scenario, even if we had a market or a deflationary event, a dramatic deflationary event, where gold doesn't get the last laugh. Because even if we had a market implosion, a Great Depression, like Zebrick says, and gold sells off, it won't last more than 20 seconds because the governments to stay in power will have to go into deficit spending and stimulus to stay in power. And that you can count on. You can count on them doing whatever it takes to not default on their treasuries, to stay in power, to fiscal and deficit spend. And then that will be inherently inflationary and gold will again rise. And everyone, whether you're a Bitcoin debate about gold, or whether you're strong dollar, weak dollar about gold, like Brent Johnson and I discussed the dollar, whether you're Ronnie Sturfula or Larry Lepard talking to Peter Schiff about Bitcoin versus gold, or you're talking deflation, inflation, we all agree that at some point gold gets the last laugh. That's not me being a gold bug. That's not Egon or Ronnie Sturfula or any Butts or even Larry Lepard or any of these Bitcoin guys. We're not gold bugs. We just see the writing on the wall about fiat money getting weaker, and there is no productivity miracle. I suppose the only other solution you could have is that you let U.S. Treasuries default. You let and therefore the big banks that own them fail, and you go into a true deflationary restructuring. You cut entitlement defense by 50%. You could reshore production, and that would probably put the Fed balance sheet at 25 to 30 trillion, deficits at 5 to 6 trillion. inflation would skyrocket, bondholders and pension funds would get killed, but gold would still go up. In other words, there's things that can happen dramatic. And I'm not predicting that. I'm saying there are things that can happen. The Fed could restructure government debt, any coupon over 1%, cut it down. That would be illegal, but we've done illegal things before when we bought corporate bonds in 2020 out of the Fed balance sheet, or when we allowed student loans to be forgiven. It's good, I think, but still illegal. So in other words, anything's possible, but no matter what they do, it's going to affect the currency. And gold still, throughout history, patiently, as Rick Rule says, rewards infrequently but extravagantly. And I don't look at it as a reward so I get paid more for my investment. I do know that that shoebox of gold coins is going to do a lot more for me and my family than a shoebox of stock certificates and fiat currencies and direct investment and SPAC IOUs and private capital pools that I could take risk on. I will sleep much better at night with that shoebox of gold coins and all this sexy material that Wall Street can throw at me, because I've got a good BS detector having been from there. Not all of them are bad, and there are guys like Jeffrey Gundlach that can pick the little gnats out of the weeds and find the good deals. Even in MBS, you can find good deals, but it's very hard for retail investors or the average man to find those good credits in a bad credit environment, or those good opportunities. Gold just helps me sleep much safely at night, much more soundly at night.
All right. So to help people that are maybe aspiring to sleep more soundly at night, we'll talk in a second about your organization and how folks might be able to buy gold through it if they're a good fit. Real quick though, Matt, and again, I'm so sorry. Like I said, I could go on for another 3 hours here, and I'm sure a lot of the viewers would like us to, but we've got to start wrapping it up. For folks that have really enjoyed this discussion and would like to follow you in your work, where should they go?
We're at von Greyerz.gold, excuse me, and it's, or just VG.gold. And that's where all our articles and interviews and all our thoughts on why gold, where to hold gold, how not to hold gold, what jurisdictions, what risks, are all can be found. You can get a little education on that website, because it's much more than just we have the safest, largest vault in the world, an in-house trading desk to convert from the refineries to currencies, all these wonderful services. But we also have a good education. Whether you're a client of ours or not, you can get a decent, objective, I think, education on the big gold questions there. But we're very much about why gold, but as importantly, it's how to own gold and how not to own gold. There's a lot of discussions there that can help you, whether you're a client of ours or not. There's a lot of free information there. And again, Egon von Greyerz and myself write a lot of white papers. Ronnie Sturfel, as an advisor, has a lot of white papers. Grant Williams. We've got a really smart team of people who understand gold and clearly have a conviction and clearly a bias. I'll be clear on that. You can make your own decisions, but it's a good spot to see what we're thinking and track the markets in gold, and also learn about the larger questions beyond just why gold.
All right. Well, so for folks that are maybe inspired to say, wow, maybe I should actually increase my percent of allocation to gold, given everything Matt just said, or people saying, I don't have any allocation to it, and then I want to make up for lost time. First off, I want to commend the work that you and your partner, Egon von Greyerz, do there. The firm you've created really is, I think, the top shelf provider in the space. And I highly recommend anybody that is a good fit for you to strongly consider working with you and your organization. Now, you're high end for a reason. You've got this unbelievable vault basically built inside of an unassailable mountain in the Swiss Alps somewhere. Nobody really knows where it is for good reason.
Yep.
So it's one of the absolute safest ways to store physical gold in your name. And so coming with all this great service and great security, obviously is a bit of a premium. So just real quickly, tell folks sort of what type of client is a good fit for your firm.
Yeah, and believe me, 99% of the people I speak to can't afford our minimums. That doesn't mean they shouldn't buy gold just because they can't be a client, or at least consider gold or think about gold. We have vaults in Singapore and Zurich that have a minimum of about 400,000 Swiss francs, US dollars. That's the minimum. For this kind of James Bond experience in this undisclosed location in the safest vault in the world in the Swiss Alps, the minimums there are 5 million Swiss franc US dollars. So that's a much higher minimum. Obviously, not everyone can meet that minimum, and we recognize that, but the key part of our service model is that we literally do talk to all our clients. We advise them not just on gold, but on all things market related. We're directly there. We go to the vaults with you. We're there we have the logistics to fly or move or transport gold in the world. We have direct relations with the refiners. So that kind of white glove service has a premium in terms of minimums. We couldn't do that if we had a retail business. It's the way Egon started it for his own family and circle of friends over a quarter century ago. That's just the model. But Egon and I write constantly about gold to anyone who can afford it, even if it's my son who buys an ounce or two every quarter just on his own. So you don't have to be a high net worth to look at gold. Unfortunately, or fortunately, the way von Greyerz works, we have high minimums, and that's for sure. But all our material discussing gold is for anyone to read. And if you can't make the minimums for von Greyerz, contact us anyway, because we have other relationships or recommendations we can give you that we could recommend. My main point, as I was telling that young PhD student yesterday, I'm just excited to see people learning about gold. Whether they become a client or not at this point in my life isn't the key driver. I really think it's important to understand currency risk, credit risk, market risk, and then you'll understand precious metal premiums. And that's up to each person to decide for themselves, of course. But I think everyone should look at gold, whether they meet our minimums or not. But for higher net worth or higher income individuals, I think, have the best service in the world. We're certainly the biggest outside of the commercial banking system. We do that for a reason. We don't trust the commercial banking system. We have direct ownership, unencumbered, no counterparty risk. We have direct access to the partners. And we have a simple service model. We put gold in the ground and we store it, and it retains its value. And you want currency from it, we'll give it to you as needed. But it's an incredibly important service model. And we have clients from over 90 countries. So Egon did build something right many, many years ago, and it continues to be that way.
All right. Well, look, folks who watch this channel know that there are financial advisory firms that Thoughtful Money endorses, and these are firms that worked with for over a decade in most cases, and have a strong degree of trust in their capabilities, their customer service, and just their trustability in treating clients right. We have just come to the point where Thoughtful Money is now giving a similar endorsement for von Greyerz gold. Obviously, as you just said, it's for a very rarefied percent of people. So folks know I'm also talking to other firms that are for people who don't have as much capital as you need to work with those guys. Yeah, and Matt's been a huge supporter of that, and he's helping make some introductions to me. But anyways, if you want to go to their check out their services, whether to be a potential client or just avail yourself of all the educational products that you have there, just go to thoughtfulmoney.com/VG. VG stands for Von Greyerz. And then if and when I've got additional firm or firms that can address people with less capital, I will be announcing that on this channel. All right, Matt, as we wrap up here, I've got one last question for you, which I'll give you 30 seconds to think of your answer to, which is, you've had a phenomenally successful career, doing great work out there in the world now. What's an important lesson you've learned along your journey that you think is worth sharing with the audience here as we wrap up?
Yeah, I've been blessed with amazing mentors from Howard Johnson, my family office, or Les Quick, or Tom Lott from Morgan Stanley, and now Egon von Greyerz. Always older, smarter, better people than me who actually took huge risks and were very brave and honest, good people. And I learned a lot from them, from how I didn't measure up in a lot of ways to what they were. Interestingly, when I was on a panel in Vancouver, Rick Rule said something that wasn't directed to me, but I think is very important, that the best investment you can make isn't in miners or equities or credits or precious metals. And this sounds so wonky and Pollyannish, but the best investment you can make is in yourselves, in myself and yourself, and for your audience. But what I mean by that is, and this is something I learned way back in school, a quote by John Kennedy: there's something immoral about abandoning your own judgment, whether that's in politics, whether that's in relationships. And again, we all make mistakes in all these areas, and whether that's in investing, and certainly whether that's in precious metals, have your own judgment. Listen to everything I say or anyone else says that comes on Thoughtful Money. I am not asking you to believe me or take me at face value and then make your decisions based on me or Grant Williams or Ronnie Sturfula or Brent Johnson or anyone else or Adam Taggart. It's really important that you get a wide arc of different perspectives. It's very important that you understand that to really make a judgment, whether it's on SPACs, private equity, precious metals, credits, that you have an informed opinion, not an emotional opinion, or not just someone else's opinion. I certainly fly on the broad wings of a lot of smarter people than me, like Gundlach or Groman, but you still have to discern your own opinion. And when I talk about gold, I have a lot of conviction, but question even what I say. I could be wrong. We could be wrong. Gold could do different things. I have super strong conviction, as I said at the beginning, but have your own opinion, have your own judgment, make it informed, go deeper than just a Twitter account or a couple of YouTube videos to really look at these things. I think we'll all start to be on the same page at some point, but we'll have different ways to that same page. But it's very important that you trust your own judgment and have an informed judgment rather than just a reactionary judgment.
It's such a great point, and I think it's a core responsibility of yours to form your own judgment. And I think one of the big reasons why we're in the predicament that we are nationally is because we have largely abdicated our judgment on how the economy should be run to this rarefied group of people with a lot of letters after their names, right? And we've just said,
Yeah,
oh, it's math,
yeah,
it's too hard. We're going to let those guys figure it out, right? And so,
yeah,
we don't have enough financial education to know what to be agitating for at the ballot box to try to push, you know, financial, economic, monetary policy up, right? We just sit and
yeah,
complain about what we get, right? Yeah, I think that's a great quote. There's something immoral about abandoning your own judgment. You need to basically uh, construct and solidify the compass points by which you are going to be making decisions in life, both individually, but also as your role as a member of society. And like I said, too many people, especially around money, we've just given that up. We've said, no, I'll let others take care of it. And when you let others drive the bus, you really can't complain if you end up in a place that you don't like, right?
yeah, yeah. It's
All
true.
right.
Very true,
Very,
Adam.
very, very well said, my friend. Well, Matt, look, it's been a fascinating and phenomenal and thoroughly enjoyable hour and 20 minutes here. Thanks so much for coming on and giving so much of your time. Really look forward to
Yeah,
having you
thank you.
back on again in the near future. Thanks so much for everything, my friend.
All right, Adam. Enjoyed as always.
All right, well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by Mike Preston and John Lodra. John, you've been on the road, so why don't we start with you? What were some of your key takeaways to this great discussion with Matt?
Hello, Adam. Great to be back with you. I did miss being with you and Mike in the recent weeks, but did have some fun travel that my wife and I did, and was appreciative for the break. But really, we always enjoy Matt's take on things. Obviously, he is and his firm are proponents of gold as an important piece of the equation in a properly diversified portfolio. We share those views, and don't view gold as a renegade asset class at all. We think it's a very important asset class. Mostly because of Matt hit it on the head when his comments started with, he said it was all about the debt. And absolutely, we see it very similarly. If you look at major crises throughout history, financial crises, uh, without fail, they have some degree of problems with debt, either debt defaults or implosions or hyperinflationary episodes that emerge from governments monetizing unsustainable debt loads. So we agree with him that the debt is really front and center as to one of the key landmines in markets and the economies globally, not just here in the U.S., but globally. Some countries are more healthy than others, and ironically, emerging markets in many jurisdictions are in healthier fiscal shape from a debt and economic activity standpoint. But I'll just share a couple of charts because I think talking about it doesn't do it justice. But when you look at charts, I think it really highlights the problem we have here. This is a chart that shows U.S. Public debt has surpassed by a good degree GDP. We have more debt than we as a country are producing in terms of economic activity. And that's a widening gap. As a percent of GDP, our debt has stepped higher, notably in response to the several crises of the last couple of decades, in response to the great financial crisis and the various rounds of QE, and then, of course, the deficit spending, debt-fueled deficit spending in response to COVID. And in recent months, we're curling up again here, 123% of GDP. And that may not seem like a problem, but the markets see it differently. This is a chart of credit default swaps on U.S. Treasuries. Now, this basically says, what you see here is here's where we were in 2009. We had a big spike up, and this is basically the market implied probability of a default on U.S. Treasury debt. Now, to be fair, these implied rates still are a pretty small probability, but the important thing is it's non-zero. There is a non-zero market perception of trouble in U.S. Treasury markets from a default standpoint. Of course, the shenanigans with debt ceiling every so many number of months doesn't help that. But it's something to be cognizant of, not to be necessarily worried about, but cognizant of that there is a problem with debt levels as they have exploded and continue to explode. Much of the baton of risk taking in debt markets has been handed to private credit markets, and that's really where we think a real problem could be brewing, and Matt talked about that. This is an article I came across earlier this year that talked about, this is a very opaque market. Private credit funds they're private. They're not traded on public exchanges. There's no market test as to what the value of these securities are. So basically, the gist of this article is that basically private fund managers, private credit managers are placing mark-to-market values of their loans in their portfolios that are oftentimes more rich or generous than other third parties do. And this just shows the degree of the chasm here that has opened up. Basically the private fund managers themselves have marked their loans at these red lines, and these are some different private credit funds. And third-party entities are valuing those loans at substantial discounts. That all speaks to a fragility in markets. And we think gold is a really important ballast there. We agree with Matt that there is a reason to hold gold that has nothing to do with rate of return, but more as an insurance policy. We happen to think there's two purposes, not just that insurance policy, especially for bullion, but we do think there's a compelling investment opportunity. We have held the gold miners for some time. We still think they're compelling valuations relative to the price of metal. We certainly can get in that. But the fragility is really, I think, what is present here and makes an insurance policy like gold really important. Just one more comment on fragility. And this is a time I'm going to be dropping a video on our own New Harbor Financial Group YouTube channel this week on this topic. But last week, without much news reporting or fanfare, June 11th, new rules were implemented for money market funds, basically allowing money market funds to put redemption gates in place so that in the event of a financial crisis, a run on the money market funds, those funds can put brakes on people getting their money out. And this may seem, kind of behind the scenes and not newsworthy, but the very fact that the SEC implemented these rules a year ago and they went live, I think, on June 11th, speaks to a fragility and doesn't take too much of a history lesson to go back and look at the problems in the repo market in 2019 to see that there are fragilities, and many money market funds actually hold things like repos. So it just speaks to all is not as stable in the system as the headlines might make it appear. That's why we think the debt is really a concern, and having things like precious metals as an important ballast is really important in a properly diversified portfolio.
Well, John, there's, I think, increasing amount of focus that's coming on the fragility of the markets. I know we want to talk a little bit about kind of the narrowing breadth of the market. When we talk about narrowing breadth, it's just fewer and fewer things that are actually continuing to prop up the market at current levels. And to your earlier comment, John, picture is worth 1,000 words. So I found a really good visualization of market fragility right now. So I thought I'd put it up here, really economic fragility. This comes from Twitter. For those that are listening on the podcast, it is the back of a house. There's a rickety sort of back balcony on the house, already kind of tilting downwards a little bit. It's only supported by um, two slats of wood pillars that are very thin and clearly bending under the weight of, of the balcony. And the balcony is titled U.S. Economy, and the two pillars are NVIDIA and Taylor Swift.
Yeah, that deck looks quite familiar from about 45 years ago in my life. That I probably would have been on that deck with about 50 other people, oblivious to the lack of support below it. But here
yeah,
we go.
probably a lot of red Solo cups under that
Yeah,
thing.
there you go.
Often, but it's funny because it's so close to reality. It hurts. There's another thing from Twitter I want to pull up here real quick that I put up the other day in response to a tweet from Lisa Abramowitz, who is a journalist at Bloomberg, if I'm not mistaken. And Matt's whole thing is the debt problem. It's not just a U.S. problem; it's a global problem. So Lisa had put up the fact here that global debt has risen 40% in the past 4 years to 97 trillion, right? That compares with 86 trillion in corporate debt and 55 trillion for households. So it's a fair amount of debt. If you add it up, which I did, that's 238 trillion of global debt. And we know that it's growing pretty fast. Just the government part of it has risen 40% in the past 4 years, right? So then you add to that unfunded liabilities. Right? These are all the things, Medicare, Medicaid, Social Security here in the US, but lots of other countries have very similar programs, especially in Europe, for their populace. I've seen estimates in the US that are in the hundreds of trillions just for America. Who knows what they are when you add in, all the other countries around the world, but it's some really big number on top of that 238 trillion, right? Then you compare that to the income side of the equation, right? So that was the liability side. The income side of the equation is global GDP is about 90 trillion, and it's only growing at 3% a year, right? And contrast that to how fast the debt pile is growing. Now you add in the aging demographics, the fact that we have fewer and fewer working people per capita supporting a growing level of aging, retirees or people that are falling out of the workforce because they're too old. And really, it's very hard to imagine this math working out, right? Where all that debt can be supported by that dwindling debt to income ratio or income to debt ratio. So, when you kind of just break it down at the high level math like that, it really does paint pretty stark picture that underscores what Matt's saying, which is that, we have this date with destiny with this big debt mountain that continues to build. And, there's two big things that Matt worries about, right? Which is economic growth will continue to suffer as that debt weighs more and more in the economy. And the bigger your debt service costs, the less that's left over to run your economy on. And eventually you get to a point where either that debt starts defaulting because the income can't service it, right? And then you have, deflation in parts of the economy, maybe deflation in asset markets. That's where you begin to take sort of immediate losses. You can have cascades that maybe begin to, seize up your financial and banking systems. And then, of course, he thinks if that starts to happen, the ruling parties are not going to, let the ship go down in their watch, and so they're just going to turn even more to the inflationary ways of, okay, well, let's meet this debt nominally just by printing, as much fiat currency as we can to kind of keep things from completely imploding. And of course, the sacrifice in that equation is the currency, it's the purchasing power of your currency, right? And so in both of those reasons, that's why he's, in both of those cases, gold is a very good thing to own. And history, time and time again, as we've seen currency regimes suffer and fail like this because of profligate spending, history is pretty clear that gold is one of the assets that, one of the few assets that really can provide a safe haven, and he thinks it will again at some point in the future. So I'll take a breath there, but Mike, we'll hand the baton to you. Anything you want to add to all that?
Thanks, Adam. There's so many gems in this talk. I really enjoyed Matt's discussion here, and I'm just looking at my notes. I'm going to throw out some highlights. that I think were really meaningful to me, at least meaningful enough to write down. John talked about the debt, and Matt, that was Matt's main theme. We're sitting here at basically $35 trillion in debt. It's increasing by nearly 3 trillion, almost 3 trillion a year, and that's before we even have a real recession. That's with equity markets at all-time highs. It's just so obvious that there is no other plan. It's terrifying, frankly. It's quite terrifying. And why this market hasn't figured it out yet, I don't know. But it's a matter of time, I think. Matt pointed out that paper money is reaching its end game. That's scary in itself. This whole notion of printing money to solve all problems is reaching its end game. What does that mean? What does that mean? What are the consequences of it when it becomes unwound? I'm not sure, but Matt rightfully pointed out, I think, that the only good story that America has is its rising markets. It's rising markets across the board: stock markets, real estate markets, collectibles markets, everything. But the problem is that it really hasn't helped the middle class much. And inflation is pretty insidious, and the Fed wants inflation. They wanted 2% inflation for the longest time. They ended up getting 9% inflation after COVID. It's trending back down, but now they're worried about inflation, right? So that's why they're not cutting rates. And here we sit at all-time highs on the S&P, close to 5,500, it looks like. And there's some talk about when is the Fed going to cut rates, and now we're wondering if the Fed's going to cut rates with stock markets at absurd valuations and sitting at all-time highs. So it really is a very strange time to be living through. He talked about the fact that we actually need to prop up stock markets and maybe even nationalize those markets and collect taxes on those markets just to pay our debt. It's absurd. I don't really think that's likely to happen. And if it does happen, I think we're all going to have to wake up and realize that we've kind of lost a lot of our freedom along the way in a stealthy fashion. So Matt also talked about the equity and private credit markets, both of them. He said the jig is up, although there's still blow off risk. And that's what's really hard about right now. It's really obvious that the breath is bad in the market. I think the top 3 stocks in the S&P account for 20% of the stock market capitalization. It's all about 3 stocks, 7 stocks. It's been that way for so long, and it's even more so in the last couple of months. The breath is bad. Our short-term indicators, even though they've just recently reversed up on the NASDAQ, are still flashing caution signals on the New York Stock Exchange and the S&P. And it's sticking out like a sore thumb, like that Taylor Swift and NVIDIA photo that you just put out there. It's like, it's so common that everyone's talking about it. And frankly, that's worrying me because it's almost too obvious. And we're at the end of a 42-year bull market here. We've got 35 trillion in debt. There is no plan B. We're throwing money at the market every single time it has a hiccup. And we're still not seeing much FOMO. I'll tell you, on the ground here, we're not seeing a lot of fear of missing out. So I've got the fear that this blow off goes a little bit longer, maybe a few more months. Who knows? It really doesn't matter because I don't think the upside in the market is that much more, maybe another 5%, something like that. You can get that risk-free return on treasury bills for 1 year. So we're cautious. We still have about 40 something percent equity exposure with tight hedges. We're trying to catch a little bit of that return, but this market, particularly if it goes on a further blow off top here, is going to reverse suddenly. And a lot of people are not going to have a plan to get out. So don't expect a V-shaped recovery after every market sell-off. I can't emphasize that enough. Matt said that. Don't expect to be bailed out the rest of your life just because it has been the last 20 years. We think that at some point the market drops and drops hard, and that there's more of an L-shaped move for a bunch of years. He talked a whole bunch more about about rate cuts in particular. A lot of people are waiting for this big rate cut. And yes, that probably would pop the equity markets, maybe even help them finish their blow off top. But it's not going to help the debt situation. We've got 35 trillion in debt, and it's not rolling over that fast. If you have a drop in rates, it doesn't really help you service that 35 trillion in debt. It helps you refinance anything that comes due at a lower rate. So that's not really going to make a big difference.
Right. And even if we get the 1 rate cut, we used to be 3, right? If we get the 1 rate cut folks are hoping for this year, well, that brings the debt from 5.25 down to 5. I mean, it's not massive relief, even if they cut rates several times. Okay, so you're down to 4.75. Again, like it's still a historic. Well, it's still a relatively high amount of interest you're paying on today's massively large debt pile, right? I mean, we really need to have rates cut down back, below 3, I think, for it to really provide injunctive relief here.
And I think they're probably going to go there. I think that rates go back below 2. They might even go back to 0 in the depths of the crisis that I think is likely to come in the next few years and the culmination of the climax of this fourth turning.
Right.
So I do
And
believe that's going to happen.
history would show that, we've shown the chart many times where every other recession that we've hit, or let me put it this way, every other instance where the Fed has hiked rates aggressively in the past 50 years and then plateaued for some period of time, we've entered recession and the Fed has had to scramble to cut rates and has been cutting rates. Yeah, there you go. There's perfect, John. So, a huge question that you have to answer if you are on the bullish camp for the next couple of years is why would it be different this time?
It won't be different this time. I think we're going to learn that this whole game was a big mistake. And I think that the social unrest is likely to be a big problem, as Matt pointed out. The middle class has been left out. The wealth effect has been solely or almost completely solely focused on the very wealthy. They're not going to notice much if equity markets fall by half. They're not going to notice much if inflation goes through the roof. But the working poor that Matt talked about will certainly notice. And so it's sad. Just in closing, he talked about in closing that America likes sweet little lies. And and sadly, I think that's what's going to continue. And I think that the public will be begging for those lies and those bailouts more and more. But the real scary moment will be when they don't work anymore, when the easy fixes, when the easy button doesn't work anymore, when the Fed cuts rates and the market tanks anyway, which it has to do historically and mathematically based on where we are here. And that's what's tough is here we are saying that we're in the end game, Matt saying we're in the end game, and yet we're both saying that there's still blow off top risk, which is this whole psychological thing that gets people, torn up inside and twisted in knots. And we're here to help people with that. So happy to have a discussion with any of you. And we're not going to say, just get out and stay in T-bills, although that's a fine thing to do as well. Usually it's a little bit more complex than that. We got to really take a look at what's causing that angst inside. Usually that angst is being caused by either fear of missing out or, fear of not having enough, that type of thing. Even the fear of, for some people, not being enough or not having enough. It's a real big thing. It's a real big thing. And I can't say that we can solve all the world's problems or all the psychological issues, but I think we've got some pretty unique experience in being in this business over the last 25 years, living through all these bubbles. And, for a good part of the last 10 years, kind of pointing out these bubbles and yet watching them go on, no matter what we say, it's giving us unique perspective and maybe even a thick skin to help people through some of those psychological challenges. So I view that to be a big part of our job.
Well, it's great that you guys do that. And Matt, he swims in the high net worth investor world, right? He made a ton of money early on in his career. He now runs, the premier gold storage company where, it really is the world elites that store their gold with him and his partner Egon von Greyerz there. And Matt is a student of history. And his comment, which I wrote down here, was the secret to making money is not losing it, right? And that's what the wealthy have been very good at, or that's how they've kept generational wealth over time, is knowing when to be aggressive, but also knowing when to be very defensive. And very clear from Matt's perspective right now, we're highly likely entering a period where the name of the game is just to lose less than everybody else, right? And that makes you better off on a relative basis. So to your point there, Mike, about being very distrustful of this market and seeing that it could correct fairly materially at some point, a very common question that I get, I'm sure you guys get, is, well, when, and is that going to matter in any timeline that's meaningful? I just want to point to a couple recent interviews on this channel, videos that came out this week. One that's releasing at the time you guys and I are recording here is with Fred Hickey of the High Tech Investor. And back to that chart of Taylor Swift and NVIDIA holding up the market. Fred is really one of the top experts in the world on what's happening in the tech sector. And you would kind of think a guy like that would have a professional bias to be more of a cheerleader for the sector. But he is extremely concerned about the incredible levels of what he would say are extreme overvaluation in the leaders in that space. And it's largely due to the mania that is, going on around generative AI. And, Fred's big issue is he says, look, we're spending hundreds of billions in this space right now. It's driving the results of companies like NVIDIA that are literally, selling the pickaxes and shovels in the space to the moon. But there just does not seem to be, at least at this point in time, any credible demonstration of a positive ROI on any meaningful timeline for that investment. He thinks that the technology of generative AI, he says, AI has been around for a good while. It is getting better, as time goes on. It is making us more productive. There's a real benefit to that. But the new darling, the generative AI stuff, he says that is an evolutionary. Those are evolutionary movements. They're not revolutionary movements, and we're pricing it like it's a transformative revolution. But in his opinion, and the analysis that he's conducted and the folks that he talks to in the sector, seems to be expressing increasing doubts about, hey, are we actually going to get our money back off of this thing? I think he said, and folks, if you're interested in this, go watch that interview. But I think he said, to date, we've seen about 5 billion in payoffs for hundreds of billions in investment right now. And in the smart money is beginning to really dial down its investment in the space. He said the VC sector, I think he said, put like $500 million into generative AI in 2023. I think he said it's down by like 75% this year. So he thinks that we're not that far away from the world kind of waking up and having a like, oh my goodness, we went a little hog wild here moment. And the moment that happens, you're going to see the valuations of these stocks get hammered because they're priced off of meteoric continued growth in revenue and profits. And as those expectations get dialed back, probably pretty severely, those stocks will really get hammered. And those are the stocks. Those are the few pillars that are propping up the shaky balcony of the economy here, right? Talked about how in 2018, the world had its first trillion-dollar company, right? Apple. That wasn't that long ago, right? 7 years, maybe 6 years. And now we have 3 companies that are each worth over 3 trillion. Collectively, they're worth 10 trillion, worth more than the market value of the entire China's entire stock market. In just 3 companies. And a huge amount of that valuation has been tacked on very recently, and it's been because of the whole generative AI mania. And so, he thinks that that's just phantom value that the market may wake up to relatively soon and say, you know what, that's not real. And as those earnings estimates come down, those stock prices come down, they drag the markets down with them because those stocks, as we've talked about, there's such narrow breadth in the market. They're propping up, a massive chunk of the market, and they're so owned across so many different ETFs. They'll pull the markets down with them, and then that's going to have big ripple effects in the economy. So that's the domino set that Fred sees there. So that could definitely do it. I also interviewed Joanne Shu, which was a really interesting new person for me to interview. She is the research director of the University of Michigan's consumer sentiment department. And so she's involved in the calculations of consumer sentiment and really understanding, digging into the data to understand what it's telling us. And she's saying that we're seeing, a very substantial rise in consumers basically saying, inflation's killing me. It's making it harder and harder for me to stay above water. And a record number of Americans now are saying that they are giving up on ever attaining the American dream, which basically is just, I want to own a home, I want to be able to retire, I want to be able to, finish each month having paid my bills with a little bit left over. And so, she's not saying that we're at dire proportions there yet, but the trajectory is not good. She's a member of the establishment, so I know she had to sort of dance a little bit around some of the questions that I asked. But kind of reading between the lines and even directly taking, her quotes, it's definitely a real concern and something where the trajectory isn't good, right? So one of the other shoes that could drop here, besides, a pretty major market correction, if the Mag 7 or Mag 5 or whoever is, gets hit by what Fred Hickey's warning about, the consumer may just be tapping it. We may be getting near to the point where they're tapping out too. So there's just a whole bunch of things that really could be the pin that pops this. Of course, another big one is the one I talk about all the time, which is the lag effect, which is just the longer that we hang out here. To your earlier charts, John, about this massive debt overhang on the economy, it just gives that lag effect more time to catch up with us. So the point to what you're talking about there, Mike, is yeah, it could still be stupid for longer. It could get stupider for longer than most imagine. But there do seem to be some very credible developments here that the longer time goes on, the probability of them catching up and arriving in force to change the game goes higher. We're getting close to the end here on time here, guys. John, I'll just maybe we end with you with just given this environment that we're talking about, the bad breadth, the sense that markets still could go higher a little bit in the short term, but it might be, picking up nickels in front of the steamroller for folks that are trying to play that game for too much longer, and the big risks that I just mentioned. How are you guys managing client capital in this environment?
We're being cautious. We're underweight equities. We still are invested. We're about 40% in equities. We try to be selective. We use some tools to help us identify different sectors that are exhibiting relative strength relative to others. And it's, an analogy there is kind of like a horse race. You have statistics of what horses have the hot hand for whatever reason. Could be they're feeling healthy. It could be the kinds of tracks they're running on. But anyways, we use similar tools to sift through the landscape of equity markets to lean whatever exposure we have in the direction of sectors and geographies that are exhibiting relative strength. We do have some kind of relief valves. We have some, tail risk hedges that if we do get an elevator drop, which happens from lofty valuations like we have now, it happens from markets that are getting narrower and narrower in breadth. The lead up to the peak in 07 kind of looked very similar to this. Very waning breadth, even though the indices were making all-time highs. Not suggesting we have the same underlying conditions as 07, but there are hallmark type of indicators here. So we're being cautious, but we're not. Fear is not a good emotion to have either. It's one needs to be prudent, have some exposure, but be mindful that probably not the time to be 100% in stocks. And certainly, even though the mega cap weighted indices that are being driven by things like NVIDIA are fun to look at on a daily basis, they're destined to have a major pullback. Can't wait to watch Fred Hickey's interview because much of what we're seeing now resembles what we saw in the tech bubble. Same kinds of exuberance, same kinds of storytelling about how disruptive this is going to be, and disruptive it may be in even a positive way, but valuations get way ahead of the true value, and so we're being very nimble. We're trying to, we still have a good chunk in very safe, zero risk, really, with tons of optionality treasury bills that are still over 5%. And that represents dry powder that we can deploy more opportunistically when we get pullbacks. But really bring it back to one's own situation. I had a lengthy financial planning update with a client that's been a client of ours for over 20 years. And it was a very positive financial planning review. They are on track to think about retiring ahead of schedule. And the point there is that they don't need to be trying to chase last gasping bits of return in a risky market. They can take a step back and realize that the return that matters for them is over the duration of their retirement period, not whether they beat the index over the next 3 months. The economics of loss are unforgiving. Even if you get 100% return, it only takes a 50% decline to wipe that out. And the converse of that is also true. A 50% decline requires 100% return just to get back to even. And we couldn't agree more with Matt Piepenburg's comment that the best way to make money, certainly in extreme markets, is to first think about not losing it or not losing deep amounts of that. So plenty to do, but caution is warranted.
Okay. All right. Well said. And we'll have to leave it there. Folks, if you'd like to see Matt come back on this program, at some point, maybe near the end of the summer, please let them know by hitting the like button and clicking on the red subscribe button below, as well as that little bell icon right next to it. I think we're only now 5,000 folks away from hitting our 100,000 subscriber milestone here on this YouTube channel. So if you haven't subscribed yet, please do take just a quick second and do that. That will really help the prospects for this channel. And if you would like to, act on anything that you heard about in this interview, whether it's increasing your exposure to the precious metals, whether it's figuring out, developing a strategy for navigating the type of future that John and Mike are talking about here, or just getting a review of your portfolio and seeing, where your vulnerabilities lie, highly recommend that you talk to your professional financial advisor, or if you don't have one, go find one that is good, but also takes into account all the issues we talked about here. If you're having trouble finding one, feel free to talk to one of the ones that Thoughtful Money endorses, perhaps even John and Mike and their team here at New Harbor Financial. To do that, just fill out the short form at thoughtfulmoney.com. Only takes a couple of seconds to fill out the form. There's no commitment to work with these guys. It's just a free public service that they offer. All right, gentlemen, thank you so much for joining me for yet another week. Who knows what the future will bring, but when it arrives, we'll have you guys here every week making sense of it all for all of us. Thanks so much. And everybody else, thanks so much for watching.
Thanks, Adam. We really appreciate it. See you soon.
Till next week, Adam. Thanks so much.